Fuel price shocks, why oil volatility threatens supply chain stability. What if a single spike in oil prices could quietly disrupt the entire global economy? Every product you buy, food, electronics, clothing, even medicine, travels through a complex global supply chain powered largely by fuel. When oil prices suddenly rise or crash, transportation costs change overnight. Shipping routes become expensive, companies scramble to adjust, and supply chains that seemed stable can suddenly become fragile. Energy is fundamentally important in transportation, and what we have in hand, whether it's a cell phone, a food, or a tablet, has been produced and transported thanks to fuel. With the current event in the Middle East, oil and natural gas tankers are stuck in the region. Shipping vessels for other goods can't move freely for security concerns. So the real question is, are global supply chains prepared for fuel price shocks? We will demonstrate why oil volatility has become one of the biggest hidden risks to global logistics, and what it means for businesses, trade, and consumers. Part 1: Oil. The lifeblood of global supply chains. Modern supply chains run on energy. And for decades that energy has been dominated by oil. Cargo ships crossing oceans, trucks delivering goods across continents, and airplanes transporting high-value products all depend heavily on petroleum-based fuel. In fact, transportation costs are often one of the largest components of global logistics expenses. Any increase in oil price, even modest, has direct consequence in the final cost of a product. When oil prices increase, shipping companies face higher fuel costs. Airlines raise cargo fees, trucking companies increase transport rates. Industries pay more for delivery and distribution. And ultimately, these costs are passed on to consumers through higher prices. But the real challenge isn't just high oil prices, it's volatility. Part 2: The real problem. Oil price volatility. Oil prices rarely move in a straight line. They are influenced by a wide range of factors: geopolitical tensions, production decisions by organizations like OPEC, conflicts in key energy regions such as the Middle East, global economic growth or recession, disruptions and sanctions. Then, only a short time later, prices surged again as the global economy reopened. Oil price already jumped over $110 per barrel last Monday. This is about 20% of increase. There is a big volatility right now. With this confusion, nobody can predict the correct price of the crude oil. According to some analysts, 20 million of oil barrels per day are lost from international market. This gap cannot be compensated in short terms. Oil infrastructures and depots are being destroyed, which will extend the recovery and stabilization of the oil market if the combat stops. I just hoped many other unpleasant surprises are not ahead. For supply chain planners, this kind of unpredictability makes logistics extremely difficult to manage. Currently, the price of oil is going up. Tough times are ahead for nations, businesses, producers, importers, and consumers. Companies must set budgets, negotiate contracts, and plan shipping months in advance. But when fuel prices swing dramatically, those plans can quickly become outdated. Part 3: The domino effect on global logistics. Fuel price shocks don't just affect one industry. As long as fuel or natural gas has been used as energy to manufacture goods, there's no possibility not to be affected. They trigger a domino effect across the entire logistics ecosystem. First, ocean shipping costs rise. The massive container ships that move goods between continents burn huge quantities of fuel. When fuel prices climb, shipping companies increase freight rates. Second, trucking costs increase. Trucks are responsible for moving goods from ports to warehouses and stores. Higher diesel prices quickly translate into higher delivery costs. Third, air cargo becomes dramatically more expensive. Air transport is the fastest but also the most fuel-intensive method of shipping goods. When oil prices spike, many companies stop using air freight unless absolutely necessary. The result: longer delivery times, rising logistics costs, and pressure on already fragile supply chains. The oil price spike puts serious pressure on less developed countries, such as in Africa, South America, some Arab countries, and many Asian nations. These countries have limited annual budgets to cover their population's needs. Now, with the trouble in the Middle East, this is a big issue for their economy. The cost of living is rising, which will badly affect vulnerable populations. Part 4. Supply chains are more fragile than before. In the past, many companies relied on lean supply chains designed to minimize costs. This approach, often called just-in-time logistics, reduces inventory and keeps goods moving efficiently, but it also creates vulnerability when fuel prices spike unexpectedly. Shipping schedules are disrupted, freight costs jump suddenly, inventory planning becomes unpredictable. Recent crises have already exposed these weaknesses. The pandemic disrupted ports and manufacturing. Geopolitical tensions created trade barriers, and rising energy prices added yet another layer of instability. Today's supply chains are not just complex, they are interdependent and sensitive to energy shocks. Part 5. Why energy and geopolitics are now. Supply chain risks. Oil markets are deeply connected to geopolitics. Many of the world's largest oil producers are located in regions where political tensions can quickly disrupt supply. For example, key shipping routes such as the Strait of Hormuz play a crucial role in global energy flows. A disruption in such choke points affects oil supply and cause prices to spike. When that happens, the impact spreads far beyond the energy sector. Higher fuel prices affect global manufacturing, food distribution, retail, logistics, and tertiary trade. In other words, energy security has become supply chain security. Part 6. How companies are trying to adapt. Facing this volatility, many companies are trying to build more resilient supply chains. One strategy is diversifying transportation methods. Instead of relying on a single shipping route or transport mode, businesses are exploring alternative options such as rail or regional suppliers. Another approach is nearshoring, moving production closer to consumer markets to reduce transportation distances and fuel exposure. Technology is also playing a role. Some companies even hedge fuel costs through financial contracts to reduce exposure to price spikes. But these strategies come with trade-offs. Resilience often means higher costs. Part 7. The future of energy in logistics. Looking ahead, the logistics sector is exploring alternatives to traditional oil-based fuels. Shipping companies are experimenting with liquefied natural gas, biofuels, methanol-powered vessels. Some companies are also investing in electrified trucking and renewable energy solutions, but the transition will take time. Global logistics infrastructure was built around petroleum fuels, and replacing that system could take decades. Until then, oil price volatility will remain a major factor shaping supply chain stability. Conclusion. Fuel price shocks may seem like a distant economic issue, but their effects are felt everywhere, from the cost of transporting goods across oceans to the price of products on store shelves. Oil volatility continues to shape global supply chains. In an increasingly interconnected world, energy markets and logistics networks are tightly linked, and as recent crises have shown, supply chain resilience may depend as much on energy stability as on operational efficiency. The big question for the future is this: will companies successfully adapt to a world of volatile fuel prices, or will energy shocks continue to disrupt global trade? Please support our work by liking, commenting, and subscribing to our channel. See you on the next one.